Clearly, there is a risk-off tone, and we mentioned rates are likely going to keep going up. We've got that decision by the Bank of Canada in less than an hour. For the markets, there is skepticism that higher rates can get inflation down to normal levels, particularly without leading to a big economic cool down. So how do you position these days? Let's get some perspective from Kathryn Rooney Vera. She's head of strategy research at BLOOMBERG Capital Markets. Wonderful to see you. Hope you're doing well.
Thank you, John. Yeah, I think it's a really complicated market in terms of how to position going into what I think is more likely than not economic contraction in 2023 here in the United States, with a high risk of a Fed not just increasing rates more than the market is anticipating to get inflation back to its 2% target, but also this very month, John, doubling the limit in terms of its quantitative tightening procedure. So this month, we're going to see a Fed that is allowing to roll off $60 billion in treasuries per month and $35 billion in mortgage-backed securities per month. This has never before been done. And I think that we're going to see at least some impact on markets, certainly on yields, but some impact on markets from now through year end. So I'm slightly more bearish than consensus.
A lot of the fresh bearishness seemed to kick up after the head of the U.S. Fed, Jay Powell. He attended that big gathering, the Jackson Hole gathering, and really tried to firmly put in front of the markets a hawkish tone. But before that, you had seen investors feeling somewhat okay, it felt like, with this higher interest rate reality. Can you talk about what has changed over the last couple of weeks?
I mean, ever since 1970, we've lived in a majority of the years in this Goldilocks scenario. So since the last hyperinflationary period back 40 years ago, we've kind of lived in the scenario of okay growth or high growth with low inflation. So the markets are preconditioned to believe that everything is going to be just fine. And in the past decade or a bit more, the Federal Reserve has done nothing but foment that conditioning, meaning that there's the Fed put, or the Fed's going to support the markets, support the economy. And I think that's an egregious error by the markets. And we've seen the market reprice this assumption in recent trading weeks. So the market has dropped, of course, and I think that's correct. The Fed has a dual mandate. It's supposed to have a 2% target and full employment. Employment here in the U.S. is definitely overheated and has been for more than a year. And inflation is more than 4 times the target. So the Fed, if it's seriously, serious about its inflation target, has to hike rates, and it's more likely than not going to go to at least 4%, if not more. The market has decided that perhaps this is the case, and the Fed is not going to be as dovish as it historically has been, because the situation is pretty dire. And I would tell you, John, one final thing is that what concerns me is that you have inflation impulses, not just from the labor market, which here in this country is extremely overheated, but you're also having a resumption of supply forces, such as China closing down again, potential flare-ups in supply chain distortions, energy crisis in Europe. A lot of these things are going to impact inflation rates here in the U.S. and globally. So the Fed has to deal with that as well. So I think the market has to be careful about assuming, as it has in past decades, that everything is going to be just fine and the Fed is here to backstop the markets.
So, and against that backdrop, we were just talking about the challenges in the cryptocurrency market, for the Canadian stock market, which has been down in 6 of the last 7 trading days. Technology stocks made a U-turn. They're down about 10% over that period of time. How would you be positioning a portfolio in this environment?
Well, in stagflation, which we're in right now, and moving into recession, which is, of course, inflation coming down and the economy contracting, The sectors that generally outperform are the defensive ones, the ones that we have inelastic demand. So staples, energy, utilities, and healthcare tend to be the sectors that outperform in this type of environment. Now, we can dabble with tech and cryptos and consumer discretionary and communication services and hope that the Fed isn't serious about inflation. But I think that's a tough bet. The sectors that I just named are interest rate sensitive. So if interest rates continue to go higher, or if we're in recession, these sectors historically underperform. So I would be positioned in have a good portion in cash, have a good portion in gold, have a good portion in commodities, have some alternatives, but certainly within the equity space, I would say value, good quality equity stock names, but certainly those defensives, I think, are where a lot of money should be allocated.
The gold stocks, however, have underperformed as well because bullion has been lagging. We've seen that strength for the U.S. dollar. Are you anticipating that U.S. dollar strength to start to cool down?
Man, I think the U.S. dollar is going to remain strong at least through year end. There's forces in favor and against the U.S., but I would say the interest rate differential with Europe is going to be one of the most important ones. And any flare-ups and geopolitical risks, of course, regardless of the dual deficit that we have here in the U.S. with double-digit fiscal deficit and current account deficit, poor debt trajectory, it's really extravagant spending beyond our means. None of that really matters when you have demand for the most liquid asset in the world, which is the Treasury. And you have the dollar, which is the sovereign reserve currency of the world. So there's always going to be that demand. So if we do get flare-ups in Taiwan with China or in Europe again, there's just going to be additional support for the Treasury and the dollar. And adding on to that, of course, the interest rate differential, I think that we should expect the dollar to remain strong for some time. I like gold because I do think that inflation is endemic now in nature, and the only thing that can take it lower is demand destruction, so economic recession and higher unemployment. I like gold also because there's some real value there. It's value we assign to it, but in the environment of inflation, of uncertainties, of geopolitical risks, I think it's a safe bet to have at least some portion of a portfolio in this asset class.
Kathryn.